right, you guys, it's 1 o'clock. Let's get this show on the road. Thank you all for joining. I apologize if you can hear these beeps for all these latecomers coming in. Folks, we got a great presentation for you today. I'm going to keep pressing these check boxes as y'all come in. Today we're talking about the Fannie Mae 2023 updates. So we're going to give you an overview of all of the stuff you need to know about what happened in the world of Fannie Mae this year, just to make sure that you're doing everything that you need to be doing to stay compliant and fend off repurchases. So we'll start by introducing our presenter. We were supposed to have a different presenter, but they are down with sickness right now. That is okay. We've got somebody else. Mr. Wes Bieber's here, who's our president and CEO, who's going to be walking you through all of the updates from this year. Wes is a 35-year veteran of the mortgage industry. He has held just about every position that you can have in the space. He has a particular specialty in regulatory compliance, but he's been an underwriter, he's been a manager, closer, loan officer, the whole gambit over those 35 years. He launched the Commonwealth Group about over a decade ago, and we do all sorts of things like contract underwriting, contract quality control, processing, and then one thing we're not going to talk about today are the condominium-related Fannie Mae updates. We had a webinar a few weeks back that covered all of that. If you missed it, shoot me an email, ndesantis@thecommonwealth.net, and I'll send you a recording of that if you want to get up to speed on all the condo stuff. We're not going to talk about that. We already did. If you do want to know about that, just let me know, and I'll send that your way. That's pretty much all I got for your intro, West. Y'all are very lucky to have West here. He's our VIP. He doesn't show up on these all the time anymore. But West, I will hand it over to you, and you can take it away if there's anything you wanted to say. Otherwise, I'll get this slideshow on the road.
I will just throw in, for those of you who are expecting to see Wes Parker today, I'm truly sorry. I am a poor stand-in for Wes, but Wes is a little under the weather today and called me this morning. We had to do an audible at the last moment, and here I am. So at any rate, he's going to be fine. He just I think he's just got something that he picked up over the holidays out, I hope, shopping for my Christmas gift, but I sort of doubt that. At any rate, hope everybody's doing well. Good afternoon to all of you in the Eastern and Central time zones, and for those of you out west who are joining us from the West Coast, I suppose it's good morning still for those of you. What we're covering today is basically some updates to some items that came across during 2023. Think of this as the year in review, so to speak. This is nothing that's particularly new. Some of this doesn't go into effect until 2024. But the guidelines have been out. So this is just kind of a catch up more than anything else on some of the guidelines that we've had. And like Nick mentioned, there have been a number of updates on the condo front in the last 12 months or so. We're not going to cover those today. We're strictly covering the credit side of the equation, a little bit on appraisal. I don't think we had a whole lot of changes there. But anyway, we're kind of covering that today. I would encourage everybody, if you were not on our condo update session, Nick, was that 2 weeks ago, I believe? I can't recall. Anyway, it's been about 2 weeks ago that we had a condo update. I'm not 100% sure if it's up on our YouTube website or our YouTube site or not, but at the very least, drop an email to Nick. I listened through it. I was not able to attend that day, but I listened through it that day, and I have to tell you, there was an amazing amount of information. So please take a moment to go back and listen to that. If you were not able to participate and listen to the replay on that, there's a lot of great information. At any rate, we'll go ahead and get started here. Like I said, this is kind of the year in review. And Nick, I think you're driving. Can you advance me to the next slide, please, sir? On that, thank you very much. What we're going to do today is just this is sort of the 30,000 foot view on a lot of these guides. On this. The first one I want to mention is 23-08 that came about in September of this year. Basically, it was an update from Fannie Mae regarding gifts and gifts of equity from people who were part of the transaction. In other words, they were folks who were maybe the seller and they're related to the buyer, in some fashion, maybe a parent selling to a child, for example. That's a pretty common scenario out there. And the question was, what do we do when they want to have a gift of equity? Well, gifts of equity and of course, financial gift is perfectly acceptable from a parent to a child for a transaction. But there had always been a little bit of a question mark of, okay, well, what if they're an interested party to the transaction? Say, for example, they are the seller. What do we do? Uh, Fannie has always been pretty, and Freddie has been pretty consistent on that, but they have kind of updated this and clarified some things for everybody. This was more of a clarification than anything else. That is an acceptable source, provided they're not affiliated with another interested party. I know that a lot of times we see a lot of deals where we have a parent selling to a child for a primary residence, other things like that. FHA has actually been pretty common, has been pretty upfront about that was acceptable. Fannie's and Freddie have kind of waffled a little bit on it, but they have finally said, yeah, that's acceptable. But they want to make sure they're not affiliated with another interested party. So in other words, where you start getting into situations where um, you've got maybe the seller who is the realtor and the child is the buyer, and it can get real convoluted at that point. We have seen a few of those, but as long as they're not related to another interested party or affiliated with them, we're okay on that as far as the gift. Gift funds from an estate. Uh, this one is kind of interesting. We don't see a lot of this, but it does come up periodically. And this was a question that we often asked Fannie Mae as we were underwriting files, because when it would come up, it was a little unclear because an estate was not listed as a source of acceptable funds in the case of a gift. Okay, what do we do? Well, what would happen would be we would have a situation where maybe somebody had passed away, and then as part of that estate, they wanted to give some equity and other things like that. As long as the estate is from is an acceptable donor. So in other words, if the estate was established by the death of the parents for the child and the money and that sort of thing, this was more of a clarification than anything else, but it is acceptable on that. So it is nice to get some clarity on that. And this was effective immediately because it was actually a little bit of a loosening and clarification of the guidelines on this. So one thing about it is Fannie's always and Freddie both have always been a little more lenient as far as gift funds are concerned or source of funds than FHA. FHA is pretty tight on that, but it's nice to get this clarification, which actually is kind of in line with what FHA has done in the past. Nick, can you move us along to the next one here? Okay, there we go. Now we got quite a bit here on trust income. For those of you who have not ever really been involved in trust income, it's been one of the more wobbly, I guess, interpretations from Fannie over the years, but they have finally given us a little more clarification on this. First of all, they did add a requirement on this. Funds that are used for trust from a down payment, for down payment, closing, reserves, etc., they have to be subtracted from the total funds available to determine if the income meets the requirements for continuity of income. This is kind of one of those clarifications from Fannie Mae that I sort of scratch my head over a little bit, because it seems kind of anybody who's underwritten for quite some time, I think they would have been following this anyway. So if you had a trust fund, and we see people, we see them, they're out there, the trust fund babies, so to speak, and money for the down payment or closing, whatever, is coming from the trust, but they're also deriving their income from the trust, similar to retirement income, I suppose, something like that. So what we saw is Fannie actually giving us a little clarification on this. It says, hey, if you've got a trust fund with, millions of dollars or whatever the number happens to be, and they're also deriving income, that trust availability is going to go down. And if there is a certain withdrawal that is set up on the trust, then we want to be sure that we've still got the continuity of income after that money has come out of the trust fund. Again, this is one of those that like I said, I just sort of scratch my head over a little, because we've dealt with this for retirement funds for a long, long time, and I think people have pretty well taken the opinion of, well, you do it the same way. But this was Fannie just giving a little clarity on this. The variable trust payments, again, dealing with trust income. If any of you want to make me as your beneficiary of trust income, I'll give you my information on, at a later time. But in a trust situation, Sometimes income is set up as a trust for the benefit of a child or somebody else on that. If it's set up as a variable trust, and something like this is going to be, for example, income from the interest drawn on the trust funds. That'd be a great example of that. They're just saying we got to have a 2-year history of that. We want to see what that is. In other words, there's quite a bit of money sitting in the trust, but it's only maybe the interest that's throwing off as income to the borrower. I will tell you a novel twist on this one, which was kind of interesting. Many years ago, we did this has been, gosh, heavens, I don't know, a long time ago now. We were involved with a trust where the father set up the trust for the benefit of his son, who apparently the son, uh, I'm not sure what the terminology would be today. I think maybe ne'er-do-well. He never held down a job, anything like that. He was always counting on daddy's money, something like that. At any rate, but they set up something which basically in the trust said that the distributions of the trust would equal to his prior year's W-2. So, and after 3 or 4 years, if it didn't reach whatever was left would be donated to charity unless it reached certain levels. So in other words, Junior had to go to work to get the money out of the trust, which I thought was a pretty slick thing because I think from what I understand, I don't think he ever did anything at any rate, but that would be an example of a variable trust because the income is coming out based on some condition where we're going to take a look at that and we're going to look at a 24-month history of receipt. Again, very similar to self-employment in a lot of ways. Occasionally you do run into the next bullet point, the fixed trust. Basically, that's where the trust is set up that basically says there's going to be a withdrawal schedule of $3,000 a month, whatever the number happens to be. And the big thing here is there's got to be enough funds in the trust to cover that for a 3-year period. So it's very similar to an annuity in that. Proof of current receipt is required. Again, this is more of a clarification than anything else from Fannie. We want to see the money coming out and we want to see the money going in to the recipient's account. And this all became effective November 1st, 2023. Again, this was more clarification, I think, than anything else from Fannie because I think there's been some misunderstanding over the years. And sometimes, as Fannie Mae sometimes says, we give both prescriptive and descriptive guidelines. Prescriptive guideline says you must have a 620 score. Boom, you either have it or you don't. A descriptive guideline is going to be something along the lines of document the source of funds. And I think there was a lot of descriptive stuff going on here, and they kind of just brought it in and said, okay, we're going to make it a little more accurate, and we're going to have hammer this down just a little bit because we've seen some problems with it. All right, Nick, if you will advance us here. And oh, by the way, we're going to finish this up today within 30 minutes, which those of you who know me well know that this is almost an impossible task, but we're going to try. The other thing here is rental income. Non-subject rental properties that have become rentals within the last 12 months. This has been kind of a bone of contention. What happens when somebody buys a property on that and it's been within the last 12 months, but we don't have a tax return on it? Pretty common situation. The new update requires the borrower to have a primary housing expense. In other words, what we're watching for here, amongst other things, is we're watching for the reverse occupancy fraud. We want to watch to see, does the borrower have primary expense? In other words, I'm buying this house. I live with my parents. I don't have any rental expense, but I'm going to lease it kind of thing. Well, yeah. Okay. That would be an example, but then they move into the property. That's an example of reverse occupancy fraud. For those of you who are out in California, you know all about this. This has been a big problem in California and a lesser problem in the other states. But in areas of high cost housing, California, we've seen it a little bit in Florida, not as much, but primarily out on the West Coast. We've seen a lot of reverse occupancy fraud. And this is one of the things that they're doing to try to cut back on that. Again, updates the requirements for the borrower to have a primary housing expense and at least a 1-year history of property management. This kind of aligns with Freddie Mac, actually, a little bit. They've kind of had that along the way to use the full amount of rental income towards qualifying. Otherwise, the amount has to be limited. Now, I'm not going to go over all the limitations. They're there in the selling guide. There's some examples given. Just go back and check those out at your leisure on that. So basically, it's pretty much the same guidance from income earned from the subject property. kind of thing. Lease agreements. This has been another interesting thing. We've seen this one here. We get a lease agreement that says they're leasing the house for $1,000 a month, and maybe it's a 1025, which is a 2 to 4 unit appraisal, and you look at the rental on the 2 to 4 units, and it only comes up to $600 a month. Okay, where did that come from on that? So we want to see evidence that the terms of the lease has gone into effect with proof of receipt for at least 2 months. So anyway, in other words, if you say that you're getting $1,000 a month, or your lease has $1,000 a month of lease income, you want to see 2 months of $1,000 going into your account from the lease, which again makes sense. One of the big arguments that I've had over the years with Fannie and Freddie and so forth, and it's not one that I win, I lose it all the time, is I've argued that if you've got somebody that is buying a house as a rental property, that you should not use any rental income from the subject, kind of thing. That's been one of my arguments, because you don't know if they're going to be successful as a landlord or not, kind of thing. They don't agree with me. That's okay. Maybe I'm a little more conservative than they are in that respect. But here's the big thing here is we want to see that the lease agreements and the 1007, which is the single family rental income, or the 1025, which is for 2 to 4, that they're matching up. That's the bottom line on this. So that's a big thing. And Mr. Nick, if you can advance us one more time here. All right. Self-employed borrowers. This has been another one where we've seen some movement here recently. And this one actually goes into effect on January 1st. So if you've got anybody working applications for this type of situation, you may want to go ahead and get them taken care of, because effective January 1st, this is going away. Now, if you are selling to investors rather than direct to Fannie, you might already be seeing this, because I know this is one thing that has kind of come out. If you've got a borrower who has less than 2 years of history of self-employment, you have a requirement for signed personal and business returns. What they've changed here is they've gone from 6 months to 12 months for the self-employment, which kind of makes sense when you think about it, because 6 months on a tax return is not that long on that. Because let's say that you had somebody who started a business in, I don't know, what year is this, Nick? I don't even know what year it is. Is it 2020? This is 2023. All right. So if you had yes, folks, let me underwrite your files. I don't even know what year it is. Okay. So if you've got somebody who maybe started a business in 2022, it used to be that there would have to be at least 6 months of self-employment on that return. Now, there were some other requirements depending on the setup and that sort of thing. But now Fannie has and Freddie have gone in and they've said, no, you got to have at least 12 months. So basically, it's got to cover a full year on that. So again, that sort of makes sense, because 6 months is really not a long time. But that's been around for a good while. So that's a pretty big change. So if you're working with a self-employed borrower and you're used to seeing the 6 month requirement for self-employment on the last tax return, it's now gone to 12. Now, I'm not 100% sure on this one. That's a terrible place to be, but I think the messaging has not changed yet from Fannie Mae. So if you run it through your DU or your LP or whatever, you may still get the 6 month messaging, depending on when your case file ID was issued too, by the way. So kind of watch that one. Be very careful with this. But I do know that on January 1st, the messaging is going to change, and they're going to be looking for at least 12 months. Now, this is only going to affect people who've only had self-employment for basically a year, kind of thing. Basically they've gone from 6 months to a year is what they've done. I will throw in, there are other things that you're going to have to consider when you do this. If you have less than 2 years of self-employment as a similar type business, what's the nature of it? There's a few other things that I'm not going to go into. Go take a look at it online. But if you are getting somebody with less than 2 years of self-employment, you may want to check your guideline on that, because sometimes there are going to be some additional considerations. I know that, for example, and I know we're talking about Fannie Mae here, but Freddie Mac says it's got to be in a similar line of business, kind of thing. So Fannie's a little more lenient on that, but do check it out if you do have that situation coming up. One of the things that will happen with all of this is the messaging should change on your DU if it hasn't already. And by the way, this came out in October, but it goes into effect January 1st. All right, so let's move on to the next one here. Tax return requirements. this is one where there has just been a lot of confusion, and I'm not sure why on that. But it's an updated policy, and it allows you to do 1 year of personal and business when, and here's the key, all self-employed businesses have been in existence for 5 years. Okay, we've never really interpreted that rule in any other way. And again, this was more of an interpretation from Fannie Mae. Um, and the thing about this is sometimes you have borrowers who have multiple businesses, kind of thing. Maybe there's 3 or 4 businesses out there. Maybe I don't know. I run a dry cleaners and a florist. I don't know. I don't know why I always think of those two in particular, but I do. At any rate, we've seen this where maybe the dry cleaning business has been in business for 10 years and the floral business has been in business, for 2, something like that. And there was always a lot of argument. Well, this person's been self-employed for, 5 years, kind of thing. Well, yeah, but they have now updated this where they're saying they want it for all the businesses. So all the businesses would have to have been in existence for 5 years. At that point, they will allow 1 year of personal and business returns. So if all the businesses have not been in business for 5 years, they're going to ask for 2. Kind of makes sense when you stop and think about it on that. And again, the borrowers had a 25% or greater ownership in the interest for the last 5 consecutive years. Occasionally, businesses change hands. This is more of a clarification on the rule. One thing to watch for in all of this, when you've got multiple businesses going on or other things like that, it's a good idea if you've got a self-employed borrower to go back and look at the rules on self-employment. One of my favorite things is most people are familiar with the 5-year limitation, but there's some other limitations, for example, in regards to when you don't have to have business returns. There are situations where you don't even have to have them. And that kind of comes in handy because not all businesses work on a 12-month fiscal year. That, by the way, that just really, I'll speak on behalf of our underwriting staff. That just really makes their day when the fiscal year for a business is different from a calendar year. It makes it a lot harder to do self-employed income, but they are out there. And depending on where you are, your fiscal year can vary quite a bit on that. Especially if it seems to happen a lot in the hospitality business. We see different fiscal years, like down in South Florida, where they have kind of an odd season kind of thing going on, or maybe in the retail trades. We do see that too. So, like I said, this when you get that situation, sometimes there are options that are available to you under Fannie Mae that you may want to look into, kind of thing. So, the old thing of get us 1 year of business tax returns for personal and business, great. Sometimes the business hasn't filed a return because they're on a different fiscal year, whatever makes it difficult on that. Or, like I said, I don't think anybody who's self-employed actually files business returns sometimes until October. I mean, good heavens, I'd be crazy. But at any rate, depending on the situation, sometimes there are some options that are there. So take a look at your situation, and Fannie does allow for that. Freddie's a little tougher on that. But again, the big thing here is all self-employed businesses now have to go to 5. If they have not been in business for 5 years, you've got to have 2 years tax returns on that. Okay, Mr. Nick, if you will advance me one more time. For those of you who are engaged in manufactured housing lending, uh, basically Fannie has said we don't require the data plate and the certification. We'll take either one. I don't know what it is about people who buy manufactured housing. I don't understand it, but we see this all the time. We have rejected loans for this because the guidance from the appraisal was you had to have both, and people would take the data plate off. They would unscrew it from the building. And, it's nothing bad per se because borrowers don't always understand that. They don't think about that kind of thing. And most likely have not been told, or if they were told, they forgot, kind of thing. And so now we've got to have either the data plate or the certification label. I can think back on some situations where we've underwritten files and we're like, the borrowers are great. The appraisal is fine. The manufactured house meets guideline. They took off the data plate and they can't find it. And we're hosed on that. So we've finally gotten rid of that one. By the way, one of the things that, and I'll mention this to everybody, and this is kind of, I guess, asking a favor of everybody, but we're going to be doing a manufactured housing webinar next year. I'm not sure of the date. I'm not sure what's up next actually, as far as these go. But if you have any suggestions for a particular topic, you can reach out to us here. You can reach out to your account executive for that with suggestions, or you can reach out to the underwriting department, or if it's related to condos or anything like that, certainly to Nick or anybody else, or to me even on that. But we're always looking for good topics, and we want to make sure that we're covering something timely. So if you have a particular suggestion on the topic, let us know. But this is one that we are going to be covering at a future webinar on manufactured housing. With the price of housing going up, it's just crazy, what it is. And manufactured housing can be a viable alternative for borrowers depending on where they're located. All right, Mr. Nick, if you can move me forward again. This is employment offers on contract. This is for when we've got something, a borrower starting at a future date. The big thing here, and I guess it makes sense to me. The contract can't be from a family member. It's got to be from a neutral third party on that. So apparently Fannie has had some problems with this. I can't recall this running across any of our underwriters' desks on this, but if it is an employment contract, it's got to be from a neutral party. Can't be from a family member or interested party to the transaction. This is one of these I never really thought about because I don't think we've ever seen it that I can recall. But I suppose there's been some fraudulent activity on that. So watch out for that one. That's with the applications on or after February 1st on that. So, all right, let's go forward one more time. This, I think everybody's probably heard already. This is the new loan limits for Fannie Mae. The base is 766,550. Depending on where you are in the country, that number can be quite a bit higher. I know for some of our customers out in the Bay Area and the San Francisco Bay Area, we see numbers over $1 million. I forget what the number was for the high cost, depending on the county and the metro area and that sort of thing. I think in the Bay Area of San Francisco, I don't remember, but it was well over $1 million for a one unit. And even in some areas that are not in the California or Washington, D.C. area, we're seeing it here in Tennessee, Nashville, Memphis, etc., where we've got loan limits in excess. But the base nationwide is 766,550. So you're there. If you're in one of these high cost areas, chances are pretty good you already know about this on that, but do check it. It's really shocking to me when I see these numbers at 766, is the nationwide base for Fannie on that. Folks, when I got into business, which I won't tell you, I mean, I think the dinosaurs had just gone extinct when I got into business, but the loan limit at the time was 110,000. 110. Can you believe that? Unbelievable. I mean, when I look at housing prices, which, by the way, that's another reason why we're going back, taking a look at a thing for manufactured housing for a webinar, because depending on where you're located in the country, we are seeing a serious housing affordability problem. And in some cases, manufactured housing is an affordable option. And I think we're going to see more of that. I don't think that's going to ever be the ultimate end goal of anybody, but at the same time, in many cases, it's better than renting on that. So don't ignore manufactured housing as part of your portfolio. I will say conventional is pretty straightforward on it. FHA, if you're going to do manufactured, you have to have Title II approval. If you don't have that, reach out to us. We'll help you with that. But like I said, manufactured housing is a great example of something that's kind of growing because of the affordability crisis. All right, and again, this is effective January 1st. That's the date of delivery to Fannie. If you're selling to investors, you've probably already had a notice from your investors that they'll accept the higher loan limits. We started seeing those popping up in October, and it has to do with their delivery. But Fannie will not accept delivery on these higher loan limits until January 1st. So if you are a seller servicer, you know this, but like I said, you're probably originating some of these already. Hopefully you are. There's good sized loans. All right, Mr. Nick, will you roll me forward one more time?
Yeah, I'm actually going to step in here, Wes.
Yeah, because
So,
I was going to say that's my that is the end of my contract.
all right, you're
So I'm
dismissed. You can log off now, Wes. Thank you very much. That was very helpful. The changes to me, they don't seem too crazy this year. We
they're
saw a lot
not.
of stuff come out during the pandemic and whatnot, but there's nothing, they're just little tweaks. There's not a whole lot you need to be super concerned about. And it's mostly, it seems like just clarification on stuff that they've already released prior. So, um, well, I'm going to shamelessly plug our services here, if you'll let me, West. My name's Nick DeSantis. I work at Condo Analytics, but we're a company of companies here at the Commonwealth. The Commonwealth Group does various services like contract underwriting, processing, quality control, as I mentioned before. But we also do consulting services. If you're interested in becoming a Fannie Mae or Freddie Mac servicer seller, we'd love to help you with that. Or, getting your HUD approval. If you need to brush up your policies, if you're currently being audited and you want us to look through everything and make sure everything is up to snuff and passes muster with the regulators, please give us a call. We'd be happy to help. Obviously, today we're talking about contract underwriting. Why you wouldn't sign up with a third party like us just as a contingency plan, I don't know why you wouldn't do that. We don't have minimums. We can do various types of underwriting. Something that's been very popular recently is the pre-approval underwriting. So we'll go in and take a look at assets, credit, income in some of those more competitive markets so that you already know that you have a good loan and you can kind of give a bank approval type letter to your clients and know that they're probably going to make it through the underwriting process just fine. But we can also underwrite your USDA loans, Federal Home Loan Bank, non-QM. If we can get the guidance for it, obviously we can't do stuff like VA yet. That might happen sometime, but we can't do that right now, or FHA. But in the future, if you do need some auxiliary resources, you're not quite sure if you're ready to hire yet, but you see the 10-year has come down 10% this month or whatever it is, and you're the market seems like it might be shifting. If you want to have people basically on staff that you don't need to pay a salary to or benefits, we are a great resource for that. We don't have minimums, so you can sign up with us and just have us in your back pocket for when you do eventually need us. So, yeah, I kind of just went through all this. We're based here in the United States. Everything's done here. You get one underwriter per loan, and they will take the loan from start to finish. You'll know exactly who to go to if you have a question or if you disagree with how they calculated self-employed income. You don't think that they added depreciation back in correctly. Whatever it is, you know exactly where you're going to have to go to work that out with your underwriter. So it's a really great service. I really can't think of any reason why you wouldn't sign up because it's pretty much a zero commitment type agreement. So that is offered to you. And if you would like to talk about that more, please do give us a call. Reach out to myself or Marty Luplo, who will walk you through how to get set up. And we can work directly out of your LOS in some instances. It's like having just an extension of your employees when you need it, but when you don't have to pay for it. It's great. So we have underwritten over 100,000 files over here. We know what we're doing. I'm sad Wes Parker couldn't join us today. He is a fantastic underwriter and he's an even better guy. He runs that department and he's excellent. He's got his CRU and AMP and all the alphabet soup stuff, but he's extremely good at what he does, and you're in very good hands with him. So give us a call if you're interested in that and you're not a current client. For our current clients, thank you. We love you. Thank you for hopping on this webinar. This is our contact information, info@thecommonwealth.net. We will send out a recording of this if you missed this or you want to share it with any of your underwriters. And it'll just be on YouTube, so you can send it around. If you do want a copy of the deck, go ahead, Wes.
And I'm going to extend the offer of our famous monetary policy on that regarding is it a free underwrite? Is that what it is? I forget.
Are you talking about the Beaver Buck?
The Beaver Bucks. So I'll let Nick fill you in on that.
Oh, sure. I didn't know we were doing that today. All right. Well, y'all are in for a treat. For people that are not current customers, we will be offering one complimentary underwrite. So if you're using one of our competitors, try us against them. I assure you, you will prefer our service over theirs. We will absorb the cost of your first underwrite to give you a taste of how it works and all that good stuff. We just need to get you set up, and then we know that you'll like the service and you'll stick around. So that opportunity is afforded to you. Why you wouldn't do that, I don't know. But if you are interested in that, we'd be happy to give you your first one complimentary. For all the current customers, though, that doesn't exactly apply to you. We're trying to add some folks. So that's pretty much it for today's webinar. I think that we ran over a little bit here, but Wes, I don't know if you want to take a stab at any questions. I haven't been looking at the chat.
I answered a couple of questions. Nick, can you confirm your email address? We did have one question on that, and I wanted you to confirm your email
Yes,
address.
I'm going to ping it out to the chat right now. I still use my Commonwealth one, so it's
okay.
that.
I wasn't sure which one it was on that. So if you'll send that out to everybody.
There you go.
We did have one question about they don't need to have ownership for 5 years, just currently. They have to have, if we're trying to use 1 year of tax returns, they've got to have 5 years of continuous ownership. They have to have been in control, is what they're looking for on that. And I think that's the only question we really had on that. So if there's any other questions, feel free to email us, and we will certainly work with that. How do we prove 5 years of ownership? And basically, your K1s are going to show that for 2 years. On your tax returns, there's usually a date of start kind of thing. So we can track that down. So at any rate, but that is certainly a big thing. So, all right. Well, if there's no other questions, we will let this go. And thank you for coming, everybody. And speaking on behalf of everybody at Commonwealth, thank you for coming. And we hope everybody has a great holiday season upcoming. And if you're like me, you'll probably eat too much. So at any rate, everybody have a great day.